Hello and welcome to this video. Today we are going to unravel an important financial concept, the hurdle rate, which has been in the news recently due to the correction in Indian financial market. But before we dive in, let us quickly take a look what's happening in the Indian stock market. As you have seen, the Nifty 50 and Sensex have experienced around 10% decline and continue to remain under pressure. Now, an obvious question arises, what's driving this decline? To understand this better, let us first take a look at what the newspaper are saying. So here I have listed out all the key factors highlighted by newspaper which are contributing to the sharp decline. However, among them one of the biggest culprit is the relentless selling by the foreign institutional investor, that is FIIs. Now you might be wondering how the hurdle rate is connected to all of this. So let's first understand its wording. The hurdle rate is the minimum rate of return that investors expect before they allocate capital to a particular market or assets. So now let us dive into the hypothetical story to understand the perspective of FIIs and how they decide which market they should park their money in. Let's consider a scenario where an investor set a hurdle rate of 10%. Now they begin searching for market to park their capital. Suppose the investor narrows it down to the three markets, India, US and China, which are offering return above the hurdle rate, that is 12%, 15% and 20% respectively. However, the actual decision is not straightforward as choosing the highest return. The offering rate is influenced by the multiple factors such as currency exchange rate, tax regime, and inflation, among others. Now let's look at an analogy to understand how these factors influence the decision and to gain better clarity on this concept. Let's take an example of an investor who sets a hurdle rate of 10% and decide to invest $1 in Indian market. Suppose at entry point the exchange rate is $1 is equal to 100 rupees. So the investor convert $1 into 100 rupees and invested it to NSC, which offers a 12% return. Now after 1 year the 100 rupees grows to 112 due to 12% return. So he decided to square off his position, but to determine the actual return he will get will be affected by the factor like taxation and exchange rate. Let's say tax slab at exit is 12.5%. So the post-tax amount will become 110. Now exchange rate will come into picture. Suppose at exit if rupees is depreciating by 4%, which I have shown you, so the exchange rate at exit will become $1 is equal to 112. So after doing all this calculation, he is going to get $1.06, which is only 6% of his initial investment. So the actual return is falling below the set hurdle rate of 10%. Hope now you have got an idea how the exchange rate, taxation and local market condition significantly influencing the effective return. Even the initial return seemed attractive. And this is one of the key reasons why FIIs have been relentlessly selling in the Indian market, as the actual return may fall below hurdle rate when these factors come into play due to recent Trump win and China containment. So that's all for this video. Hope you have got a clear understanding of this entire concept. If you found this video helpful, don't forget to hit the like button and subscribe to my channel for more such insight. Thank you for watching.